Hello and welcome to the world of finance and investing. In this video, we'll look at Benjamin Graham's security analysis. Takeaway number 1. Investing versus speculating. What exactly is the distinction between an investor and a speculator? Is it because the former wears a tie and works in a fancy office on a fancy street in cities like New York, London, or Stockholm, while the latter gambles with his mortgage at a casino? No, I believe we require a more useful definition. Distinguishing between investing and speculation is at the heart of security analysis because knowing which one you are involved in is critical for the sake of your portfolio returns. In fact, most of the aforementioned tie-wearing Wall Streeters are speculators, according to Benjamin Graham. It's just that they cover their bets really well with stock speculation in strong companies. According to Benjamin Graham and David Dodd, an investment operation is one that, upon thorough analysis, promises safety of principal and a satisfactory return. Operations that do not meet these requirements are speculative. This quote most likely raises more questions than it answers. So, let us break it down thoroughly. Benjamin Graham emphasizes the importance of conducting a thorough examination of the available facts, with an attempt to draw conclusions based on sound logic and established principles. Purchasing Netflix at 140 times its highest reported yearly earnings, for example, is speculation rather than investment. Because the evaluation clearly relies on future expectations rather than available facts. Security market safety is never achieved under all conditions, but the investor must protect himself under all normal or reasonably likely conditions. Benjamin Graham is famous for coining the phrase, margin of safety, which allows for protection by requiring that the value of a security be purchased only when it can be obtained with a margin to the price. Buying Apple at $210 per share, for example. If you believe it is actually worth $220 per share, you should always account for the possibility of being wrong in your analysis. However, as discussed further in The Intelligence Investor, a satisfactory return is truly subjective. Any return that the investor is willing to accept will suffice here as long as he acts intelligently. If it is possible to acquire U.S. Treasury bills yield 5% per year. However, for some reason, he chooses to invest his money in a microcap mining stock with a 4% expected return. Even if he has safety and a thorough analysis in place, it would not be considered an investment operation. Furthermore, an investment operation is one that can be justified on both quantitative and qualitative grounds, but more on this later. Returning to the previously mentioned Netflix case, takeaway number 3 is that the analyst is not convinced that the market valuation of Netflix is correct, but rather that it is not correct. He would classify a significant portion of the price as speculative in the sense that it is paid for expected rather than demonstrated results. Benjamin Graham provides an excellent chart of how the price of a security is determined, indicating which components are investment and which are speculative. In the case of Netflix, a large portion of the current market cap of nearly $170 billion is comprised of market factors that are 100% speculative and future value factors that are part speculative and part investment, while only a small portion is comprised of true investment value, which Benjamin Graham refers to as intrinsic value factors. Takeaway #2. Securities classification. So we now have a basic understanding of the distinction between an investment and speculation. This series will concentrate on the former. However, there are numerous types of securities that may qualify for investment purposes, which we will now briefly outline. Bonds, preferred stocks, and common stocks are the traditional classifications. Bonds have an unqualified right to fixed interest payments. An unqualified right to the repayment of the loan or principal amount, but no other rights to assets or profits. Despite its name, preferred stock is more like a bond than a stock. It has a stated dividend, but nothing must be paid if the common stock does not receive anything as well. It has the right to its principal if the company goes bankrupt and receives money before any common stockholder, and, like the bond, it does not participate in the company's excess profits. The common stock has the right to all assets and profits over and above what bond and preferred stockholders have received. People usually refer to this type of security when they talk about stocks, because common stocks aren't guaranteed anything. Many people believe that stocks are always speculative and bonds are always investments. This is not correct. A bondholder is promised that he will be repaid, but that promise is only as good as the company that is making it. rather than organizing securities by their titles. According to Benjamin Graham, Securities should be organized based on their normal behavior after purchase. Why? Because the categories can then be treated similarly in terms of investment. The first category, according to the suggestion, is made up of fixed-value securities. It is made up of high-quality bonds and preferred stock. And the assumption is that you should be able to ignore them and collect the interest payments. The second category consists of senior securities with variable values. It is divided into two parts: high-quality issues with profit potential, such as convertible bonds, and low-quality issues, such as low-grade bonds and preferred stocks. Common stocks are the final category. In the third and fourth videos of this series, takeaway #3, quantitative analysis versus qualitative analysis, we'll look at these categories in greater depth. Takeaway number 1 taught us that an investment operation must be justified both quantitatively and qualitatively. We'll now look at what that means in practice. To be considered an investment operation, an analysis must be thorough. The problem is that even in Graham's day, the supply of information for a single security was typically more than an analyst could sift through, and Graham only lived to see the dawn of the information age. The supply of information has grown exponentially over the last few decades, and an investor can only consume so much of it. The depth of his analysis should thus be determined by the amount he has invested, as this is a good indicator of how much value additional analysis can add. If Warren Buffett can increase his yearly returns by 1%, he will increase his income by approximately $1,900 depending on how much time you must invest to achieve that extra return, which may or may not be time well spent. There are two types of information: quantitative and qualitative. Quantitative data includes capitalization, earnings and dividends, assets and liabilities, and operating statistics, while qualitative data includes things like management quality, customer preferences and trends, competitive landscape, and technological change. This book is heavily focused on quantitative data. After all, it's called value investing, and according to Benjamin Graham, the former are fewer in number, easier to obtain, and much better suited to the formation of definite and dependable conclusions. Furthermore, quantitative data typically reveals a great deal about qualitative factors as well. Is the management capable? Under their leadership, the company's earnings, assets, and dividends increased. In that case, yes, very competent. However, quantitative data are only useful if they are supported by a qualitative survey of the enterprise. Takeaway: the wise investor will insist on both quantitative and qualitative validation of his investments. The analyst faces 4 challenges. There are 3 major challenges that make successful security analysis more difficult than it appears. On the surface, these are insufficient or incorrect data, future uncertainties, and irrational market behavior. For now, it will suffice to say that data in company reports may not always present the situation in a useful manner to the investor in general. We will discuss the first point in much greater detail in the second video, when we dive into the 2 major financial statements of a company: the income statement and the balance sheet. When you suspect a company is using questionable accounting principles, avoid all of the company's securities. A quantitative deduction cannot be made to allow for unethical management. The only way to deal with such situations is to avoid them. Take a look at this list of businesses to learn more. What do you think the common denominator is if you say they were all Fortune 500 companies in 1955 but no longer are? Excellent work. Indeed, in 2014, of the companies on the Fortune 500 list since 1955 had been replaced, either by going out of business, being surpassed by new companies, or being acquired by other major players. These were some of the companies with the highest profit margins, highest earnings trends, and best financial positions. However, in investing, the future frequently disregards statistical data, even if the investor concludes that there is a discrepancy between a security's true, so-called intrinsic value and its price. The market may fail to recognize its error, even after holding onto the same security for years, during which time the market remains irrational. The investor may have to see how his original thesis is no longer valid. As a result, he will have to sell that security at a loss. Takeaway #5. Investing is the pursuit of exceptional cases. So investing appears to be difficult. Is it so difficult that the factors mentioned in the previous takeaway negate the analyst's efforts? Yes, the answer is yes. The intelligent investor will have to analyze a large number of companies in most cases, but not all. In most cases, he will conclude that its securities cannot be purchased with the aforementioned margin of safety while also producing a satisfactory return. However, he will eventually find investments where both are available. Security analysis is not an exact science. You should only intervene in exceptional circumstances. In The Common Stock of Wright Aeronautical, Benjamin Graham provides a great example of this. That was priced at $8 per share in 1922, when it had been earning $2 per share for some time and had more than $8 per share in cash only. It would have been difficult to decide whether Wright Aeronautical was worth $20 or even $40 at this point, but thankfully, that wasn't necessary to conclude that the stock was worth $8. Without knowing a man's exact weight, it's easy to see that he's heavier than he should be. As a result, the buyer of securities should be concerned with reasonable accuracy rather than exactitude. After all, the analyst is working with data from the past, which, as we've already discussed, isn't always respected by the future. Here's a quick rundown. An investment operation is one that, after careful consideration, promises both principal safety and a satisfactory return. There are numerous types of securities that can be used in investment operations. They are not, however, purchased under the same conditions. Qualitative observations must always be used to validate quantitative data. The analyst's work is complicated by incorrect data, future uncertainties, and market irrationality, but this does not negate it. One of the analyst's greatest advantages is that he can and should only act in exceptional circumstances. Following that, I will discuss the ins and outs of common stock investing and, finally, senior securities. Cheers. We'll go over income statements and balance sheets. I'll go over why they're important to think about and what to look for. Not as an accountant, but as a business owner. If you aren't familiar with these two financial statements. Takeaway number 1. Examine the income statement. Let's begin with the income accounts. This reveals a company's historical earnings, which is a good indicator of how much investors have received during the same time period. The accounting aspect of this statement is studied separately under 3 headings. What were the actual earnings in the past? The business aspect, what does this portend for the future, and the investment aspect based on this portent. What is a reasonable security valuation? In the previous video, I stated that data in company reports may not always present the situation to the investor in a useful manner. Allow me to present an absurd hypothetical example to demonstrate why. Imagine you have the option of investing in one of 3 different YouTubers, A, B, and C. They make videos in the same genre. They all make the same amount of money from ads, say $500 per year, and they all have 100 shares outstanding. During their first year of operation, they all purchased computers for their businesses. YouTuber A paid $2,500 for his, while YouTubers B and C paid $1,250 for theirs. In other words, write down the value of their computers over a 5-year period, whereas C decides to write off the entire stated value in the balance sheet in a single year, and 2 years later you decide to invest in one of these businesses. When looking at the earnings for year 2, it may appear that company A earned nothing, B earned $2.50 per share, and C earned $5 per share. When the novice investor notices this, he is unwilling to pay a high price for sharing company A. Perhaps just a speculative $2, hoping that B and C's profit margins will increase soon. On the other hand, he might be willing to pay, say, 10 times the annual earnings, or $25.50 per share. Someone interested in purchasing the entire business would recognize how absurd it is to pay 25 times more for a similar company that generates the same amount of cash. Apart from the company, Na has assets worth $2,500. Whereas C. According to the books, it does not have assets worth $1,750. So there's even a case to be made for paying more for company A than for company C. Even if this example is a bit extreme, I hope you get the point that earnings play a significant role in determining company valuation. Yet, at times, it reveals so little about how the business is really doing. You must be able to adjust the earnings yourself in order to provide a more accurate representation of the past. And in order to do so, we must first learn about some of the most common ways that companies distort their performance, which, unfortunately, are usually disguised better than in the hypothetical example I just showed. Takeaway number 26. Common methods for misrepresenting earnings when determining past earnings. We want to know what Benjamin Graham refers to as the company's earnings power. This can be considered the business's ordinary operating earnings, but the analyst must keep in mind that even after adjustments, he will only be getting a more nearly correct version of the past. Correcting the income statement is done through a versus a negative approach, as Nassim Taleb would call it. We remove what is incorrect, and then we have something that is correct. Here are 6 common ways to confuse investors accelerating depreciation, and here's how our depreciation works. In theory, if a capital asset has a limited life, provisions must be made to write off the asset's cost through charges against earnings distributed over the asset's life. In practice, however, businesses do not always adhere to this. Sometimes they decide to write off these assets sooner than the asset's life expectancy suggests. Like the YouTuber mentioned in our previous takeaway. As a result, earnings in the following years will appear to be higher than they are. Be aware of decelerating depreciation. At times, depreciation occurs too slowly. If YouTuber A, for example, had used a straight-line depreciation over 10 years rather than 5, it would have appeared as if he had earned $250 more per year. However, his company's earnings power would not have been $250 stronger, nor would it have been worth more to an investor simply because he used a different method of accounting, allocating expenses to the balance sheet rather than the income statement. Companies sometimes capitalize normal operating costs, which means that they reduce their expenses in the income statement by moving them to the balance sheet, building up long-term assets. As a result, earnings on the income statement are increased. The YouTuber is in a unique situation here. If he creates content that can be consumed over a long period of time, should the expenses associated with his video production be considered operating or capital expenses, pretending that everything is extraordinary? Extraordinary expenses should typically be removed, increasing the numbers when calculating a company's true earnings power. However, as you may have guessed, some businesses are deceptive in this regard. Let's say the YouTuber spent so much money that he didn't make much money. He'll have to write down the value of the much on his balance sheet, which will have a negative impact on earnings. However, if he decides to call this expense extraordinary, the typical investor will typically overlook it in his business valuation, recording revenues prematurely even though all services in a contract have not yet been fulfilled. All earnings are allowed to be recorded in the current period. Let's say the YouTuber has a partnership with another channel where he's supposed to create a new series for which he's paid when the fall series is finished at the end of the first year. He might have completed, say, half the series but decides to record the full contractual revenue in the current year anyway, moving current expenses to the next year or the year after that. The height of hypocrisy is reached. Let's say a YouTuber wants to set up a website for his channel and hires a programmer to do so, and the company records its earnings prematurely but then takes the exact opposite stance when it comes to expenses. Even if the website is operational, there is still an ongoing contract for updates and maintenance. After the first year, the investor will want to see the expenses accumulated so far in the income statement, but the books may fail to show this as future services still remain if you are uncertain always compared to competitors within the same industry, something we'll discuss in the next video. And also remember that security analysis is a severely practical activity and it must not linger over matters that are not likely to affect the business. Takeaway number 3. What does this mean for the future? Okay, so we've answered the first question. What are the true earnings of the past? Now for the second question. What does this mean for the future? Consider 2 distinct types of hypothetical earnings records. Which do you believe is a better guide for the future? Obviously, as we stated in the previous video, the future is no respecter of the past, and this remains true, but past earnings provide a rough indication that you can trust more if the earnings record is longer, an average is used, it includes entire market cycles, and the business is stable. Following that, how do you expect these 2 companies' earnings to develop over the next 5 years? According to Benjamin Graham, it is extremely tempting to simply project past earnings trends into the future. However, one must exercise extreme caution when doing so. Investment value can only be related to demonstrated performance and competition regulation. In the third, neither abnormally good nor abnormally bad conditions for a business last forever due to the law of diminishing returns, etc. And the fourth video will address the third question. What is a reasonable security valuation takeaway? Fourth, examine the balance sheet. We've now reached another critical financial statement that existed during Benjamin Graham's time as an investor. Instead of using only earnings from the income statement as a basis for your investment, which, as we've seen, are both fluctuating and subject to misleading representation. Use the balance sheet. Why not use a twofold test going back to remove number 1? Surely you want to acquire the YouTuber with a more valuable asset. Is everything else the same? I'm talking about if he decides to stop posting these YouTube videos and leave the company. You can at the very least sell his computer on eBay and recoup some of your investment, limiting the risk. The typical goal of balance sheet analysis is to identify weak companies. For example, you can determine if the company has liquidity issues by looking at the current ratio and insisting that it is greater than 2. Problems paying interest charges by looking at the interest coverage ratio. Too much or perhaps too little debt. And problems with sales by looking at inventory levels and how they have changed over time. Don't overlook the balance sheet assets and liabilities. They may not be as exciting as revenues and profits, but they are just as important for the astute investor and more reliable. Takeaway number 5. The significance of capitalization structure, a key component of the balance sheet, is that of how the company has been financed, which is frequently a mix of equity and liabilities, sometimes issued as bonds. This is referred to as a company's capitalization structure. Let's get back to the 3. YouTubers ignore their computers, but keep in mind that they earn $500 per year. A company is entirely funded by equity. Company B has a mix of common stock and $2,000 in bonds with a 5% interest rate, whereas Company C does not. Has common stock and $6,000 in bonds, both of which are yielding 5%. After deducting interest expenses from each of these companies' revenues, they were paid the following amounts each year. Assume once more that their common stock is worth a PE. As a result, the total value of the company's common stock should be as follows, adding the value of the bonds to reach a total valuation for each company. We discovered something intriguing. Company B's total value is $1,000, or 20% greater than that of A. And C's enterprise value is $3,000 higher, or 60% higher. How can companies with identical earnings power be valued so differently based solely on capitalization? Can it provide an answer to this question? We need to know if it's reasonable to value the common stock at a PE. Let's compare Company B to Company A on a scale of 10 and the bonds at the so-called power value in each of these cases. There is no reason to believe that Company B's bonds will be priced lower than par. The company is earning 5 times its interest expenses, providing a margin of safety. The 4th video is available. Sure, Company B's common stockholders are more vulnerable to revenue declines than Company A. However, this is offset by the leverage they have over shareholders of Company A. In the event of an increase, as perplexing as it may appear, we must accept that Company B is worth $6,000, or 20% more than Company A, solely because of its capitalization structure. The following is stated by Benjamin Graham. As a general rule, the best capitalization structure for a company includes senior securities to the extent that they can be safely issued and purchased for investment with the Company C. On the other hand, we are not convinced of the safety and purchased for investment purposes. A bond that earns only 1.66 times its interest expense is not considered safe. According to Graham, the threshold for industrial companies is 3. Furthermore, the earnings of Company C's common stock are even more leveraged, and thus up and down swings in revenue have an even greater percentage effect on shareholder profits. However, in this case, the leverage may frighten some conservative investors, reducing demand for the stock and, as a result, the price and the P. As a result, it is safe to say that the value of Company C would not total $8,000, and it could be valued even lower than Company A. Finally, we refer to the capitalization of Company A or the conservative that would be appropriate or suitable, as well as that of C. Speculative. It's time for a wrap-up. The first priority in analyzing an income statement is to determine what the true earnings were in the past. Earnings can be misrepresented in a variety of ways. By being aware of these ploys, the astute investor can adjust historical figures to more accurate version averages. Long track records also make assumptions about future earnings more reliable, helping to weed out weak companies. By carefully examining balance sheets, some debts can actually benefit the common stock investor because the amount invested becomes more productive when a reasonable portion of the capital is borrowed. It's finally time to talk about common stocks in the following video. Following that, in the final video of this mini-series, we'll talk about senior securities. Cheers.
How do you identify undervalued individual stocks? Is it possible to time the market, and how do you conduct a comparative analysis? These are just a few of the topics that will be covered. I discussed the distinctions between speculation and investing, as well as income statements and balance sheets. They are not strictly necessary, but they are highly recommended. When Benjamin Graham and David Dodd published the second edition of Security Analysis in 1940, stocks were valued at 12 times their annual earnings on average. Stock prices are nearly twice as high today, but don't let that deter you. It is still possible to achieve market success. Let's find out how. The first takeaway when looking for undervalued stocks: the risk of paying the wrong price is almost as great as the risk of buying the wrong stock. There are two approaches to finding undervalued individual stock issues in the stock market, according to Benjamin Graham. One method is to use comparative analysis, which will lead you to the next takeaway, and to scrutinizing corporate reports as they become available. Philip A. Fisher, one of the most successful investors implementing strategy, was screening about 250 companies before deciding to invest in a single growth stock. Warren Buffett, who famously reads about 500 pages of annual reports and the like every day, is the most successful investor implementing strategy too. Whichever strategy you choose to follow, you want to look for discrepancies between the intrinsic value of the company and its pricing mistakes. Individual problems are frequently the result of exaggeration, oversimplification, or neglect. Here are two scenarios in which the market typically overestimates the true value of an issue's dividend increases. According to Benjamin Graham, an increase in dividends is a positive development for the stock, but not so positive that the stock should rise by $20 because of a $5 to $6 increase in dividends. The buyer at the higher price has already paid in advance for 20 years of extra dividends from the new rate mergers and spin-offs. Wall Street enjoys a flurry of activity, but to be equally enthusiastic about mergers and spin-offs is somewhat hypocritical given that they are diametrically opposed. When it comes to mergers, you may have heard that 2 plus 2 equals 5, but did you also know that 5 divided by 2 equals 3? And here are two situations in which the market tends to undervalue litigations. Investors are typically scared off when companies are threatened with lawsuits, but often the consequences aren't as severe as the drop in price indicates financial difficulties. Don't buy companies that are likely to fall into financial difficulties by those that have already done so. If you follow this strategy, Benjamin Graham advises you to be cautious and diversify widely because many of the investments will fail. 2. Comparative analysis. In this section, I will demonstrate one method of locating undervalued stocks by conducting a comparative analysis of the world's 4 largest fashion retailers: Inditex, H&M, and Zara. Rapid retailing. Also, keep in mind that figures in these types of comparisons are only useful for large and obvious differences. Before we begin, I believe it is necessary to state a disclaimer. Let's put these fashion titans up against one another. I've chosen to examine the key earning power ratios listed below. I chose gross margin, operating margin, net margin, return on assets, return on equity, and dividend yield as my metrics. In the case of retailers, gross margin may be especially important to investigate. This reveals the average markup that the company receives on products sold. We can see that Inditex outperforms the others in terms of sales margins, and that Inditex and Gap outperform the others in terms of profiting from money on the balance sheet. It's also worth considering how these companies have managed to increase their sales in less than a decade. False retailing has clearly outgrown the others, followed by Inditex. H&M. Finally, there is the Gap. If the company's growth had stalled, I would be more concerned about fast retailing paying such a low dividend. However, it appears that the excess capital in this case is being put to good use in the business in terms of financial stability. I examined the interest coverage ratio, quick ratio, and equity to assets ratio. The interest coverage ratio is a critical metric to consider when investing in bonds or preferred stocks, as you will see in the following video. However, all 4 of these companies easily pass Graham's test in terms of the quick ratio. H&M appears to be quite frail. But, given the company's profitability, I wouldn't be too concerned. Inditex has the least debt, which is more than just a defensive advantage. The company also has more financial muscle than its competitors to make a bold offensive move, such as acquiring another company. You also want to see that the executives of a company in which you invest have skin in the game, in the sense that they own stock in the company just like you. Inditex's Ortega family still owns approximately 59% of the company. H's passionate family, M, owns 46% of the company. The Fast Retailing family owns 44%, while the Gap Fisher family owns 36%. So they all get a free pass here as well. According to Benjamin Graham, one should look at industry-specific ratios, and for the fashion retailing industry, I'd like to see a low or negative change in inventory valuation compared to the previous year, as well as a high inventory turnover. There have also been a lot of online sales. Fast Retailing increased its inventory by 59% year-on-year, which is a red flag that necessitates further investigation. The company's inventory turnover is still adequate, so it's a significant increase. However, despite its low levels of online sales, Gap stands out as the most successful adopter of this new trend. At this point, I'd say Inditex appears to be the best option. It's not really weak anywhere, and it's also the strongest company in many ways, but there's something missing. For price comparison, I've chosen price to earnings, price to equity, and price to sales. Inditex is, unsurprisingly, one of the most expensive corporations. Fast Retailing is more expensive, and before investing in this company, one should consider whether the market is overly focused on its current sales trend, because the company does not stand out in any other way. In contrast, one should consider whether Gap truly deserves to be valued at only 1/6 of Fast Retailing earnings or roughly 2/5 of its two main competitors. Following this quantitative analysis, the investor must remember to confirm his beliefs qualitatively as well. However, this activity is time-consuming, which is why a comparative analysis like this one is beneficial. First, if I had to choose specific companies from this comparison for the time-consuming pot, I'd obviously go with H&M. To conduct a more thorough investigation. How can one not want to invest in the company's Swedish crown jewel? Let's be serious here. If I had to choose, I'd look into Inditex and the Gap for a possible investment. The third takeaway from investing in stocks is to look for areas of weakness. Stock investing is always a bet on the future. However, as Benjamin Graham puts it, the analyst must consider potential future changes, but his primary goal is to protect against them rather than profit from them. He recommends looking for individual stocks that are appealing based on what they've already proven rather than what they might prove in the future. Assume you're looking to buy a used car for $1,000. If the car continues to do what it is supposed to do for a few more years, this will turn out to be a steal. Now all you have to do is protect yourself from the downside. When investing in stocks, look for the following red flags. Questionable accounting policies may cause problems in the future. I've said it before, but it bears repeating. You cannot make a quantitative deduction to allow for unethical management. Avoiding such situations is the only way to deal with them. A rapidly increasing inventory is causing financial problems. Weak earning power combined with a large number of current liabilities, rapidly increasing debts, and so on. All of these are examples of new competition when investing in consumer-oriented businesses. This is quite obvious. In 2012, I invested in Betsson, a Swedish online casino embedding company. After about 2 years, the only thing you saw on Swedish television commercials was online casinos. This was bad news for my investment, and I eventually decided to fire a deteriorating management team. If you forgot about Warren Buffett's rule of only buying stocks in companies that are so fantastic that only idiots can run them. Be wary of deteriorating management earnings with a cap. Companies' expansion opportunities can be severely limited at times. It could be due to market constraints or to government regulations. But, in any case, avoid such stocks. If your upside is limited, you might as well invest in bonds, which will get you in the next video convertibles and stock options. This can be subtle, but be wary of companies that have issued a large number of convertible securities and stock options. If the company does well and its total value rises, which is the only reason you invested in the stock in the first place, these securities will be converted into common stock, diluting your returns. Takeaway number 4. Invest in stocks that are worth less than their net current assets. Let's go back to the balance sheet for a closer look at one method for identifying undervalued stocks. Benjamin Graham is well known for looking for companies that are undervalued in relation to their net current assets. So-called net stocks are calculated by taking current assets and subtracting all liabilities. If a company is valued lower than this, it can be liquidated for more money than what you paid for it. The most common objection to purchasing a net stock is that it may continue to lose money because, well, they typically do lose money until the company's intrinsic value is less than the price paid by the investor. Managers, for example, are often opposed to the idea of liquidating the company because it implies that they will undoubtedly lose their jobs. On the other hand, there are plenty of positive things that can happen that can change the situation in the opposite direction. Earnings can increase as a result of the company improving or the industry improving in general. Competitors may decide to buy the company, and the managers may decide that liquidating the company is the best decision after all. Finding net stocks is typically quite uncommon during normal financial conditions. During the 1938 bear market, Benjamin Graham observed that approximately 20% of all industrial companies were valued below their net current assets at some point during the year. I examined data from 2018. On the other hand, I discovered that only 1.5% met this criterion. Takeaway #5. Market timing. Is it possible to predict the market's ups and downs with any degree of accuracy? The discussion that follows will not provide an exhaustive answer to this question, but it will reveal how successful 5 different strategies for investing in the S have been. If they had been applied over the last 50 years, the Page 500 index would have been. Benjamin Graham and David Dodd reject market timing strategies that aren't directly related to fundamental values. So, for this comparison, none of these strategies will be based solely on price indicators, as a swing trading strategy might. The terms are as follows. The main thing to remember is that each year, the 5 investors who implement these strategies receive an additional $10,000 adjusted for inflation. This is money they've managed to save and set aside for investing. Here's another disclaimer. Let's meet our 5 investors all in one place. Anthony is the guy who simply invests everything in the stock market whenever he gets the chance, which in our simplified example is every January 1st. Following that is Earnings Edward, who keeps some cash on the side if the average PE ratios of the S and the P500 index is high in comparison to the previous 10 years. Sales Sophie behaves similarly, but she considers the price-to-sales ratio rather than the price-to-earnings ratio. Betty employs a variation of the method advocated by Graham in this book, investing in stocks only when the S. In addition, the P500 PE ratio is favorable when compared to the yield on a 10-year U.S. government bond. Finally, we have 5050 Francis, who employs the strategy suggested in The Intelligence Investor, attempting to maintain a portfolio of 50% stocks and 50% bonds. From 1969 to 1979, if stocks have fallen in value, he will buy more of them to restore equilibrium, and he will do the opposite if stocks have greatly increased in value. These are the outcomes of these strategies over the first decade. At this point, the race is quite tight, and even though you can't see him, Anthony is lurking somewhere nearby, and you can bet that he's all in it to win it. From 1979 to 1989, it was truly a great time to own stocks. That is why many people refer to this time period as the Roaring '80s, and none of the investors flinched during the Black Monday. 1989 to 1999, it appears. At the end of this decade, we're in full dot-com bull market mode, and it's not surprising that Anthony is beginning to create a gap between himself and the others. But can he keep it up from 1999 to 2009? To refer to these prices as representing investment values or investor appraisals is to insult either the English language or common sense, or both. Yes, this was the end of the dot-com bubble. Unfortunately, all investing strategies suffered losses during the dot-com bubble burst and the financial crisis, some more than others, though by the end of the decade, Anthony is still in the lead, but it's no surprise that investors refer to this period as the lost decade, 2009 to 2019. And Anthony is the sole winner. Over the course of 50 years, His strategy was able to generate approximately 1.5% more than 50 Francis, and 0.5% more than the others in terms of yearly returns. As you can see, this results in a significant difference in portfolio values. However, such strategies are not without flaws. Unfortunately, because the future may not look exactly like the past and because the methods require a significant amount of human fortitude to stick with time, for a summary, when doing a comparative analysis, use a comparative analysis or scrutinize individual company reports to find undervalued stocks. Remember that only obvious differences matter, and that it is primarily used to quickly reduce the number of companies considered for investment. The future is primarily something to be wary of. Weed out weak companies. Stocks valued less than net current assets may represent true investment bargains, but you'll typically find them only during times of financial distress. It's difficult to time the market, and an all-in dollar cost averaging strategy appears to be very difficult to beat the next time we look at senior securities. I know what you're thinking. The next time we look at senior securities, there's no way I'll be watching that bones get a better return stuffing that money under a mattress. Yes, bond deals are historically low, but there are a few exceptions that are still worth considering.
Let's begin with fixed income investments. The first takeaway. Fixed income investments, corporate bonds, and fixed income investment senior securities involve issues where changes in market price can be said to have only a minor impact on the investment's upside. The primary motivation for investors in such securities is to generate a steady stream of passive income. As a result, it must be limited to high-quality securities. Bonds are essentially the only securities issued against a fixed interest rate. The interest rate or yield is typically paid out once or twice a year in the form of a coupon and is determined by the company's quality and the time to maturity. In other words, when is the loan expected to be repaid? McDonald's, for example, recently released 2 new issues with maturities in 2026 and 2034. And the results are 0.89% and 2.87%, respectively. While Sanofi, a major pharmaceutical company with a better credit rating than McDonald's, recently issued a 2034 issue with a yield of only 1.23%. #1 bonds have an unqualified right to fixed interest payments, as stated in the video. An unqualified right to repayment of the loan or principal amount, but no other rights to assets or profits. Here are 4 guidelines for selecting fixed income bonds. When purchasing bonds for fixed income investments, one measure of safety is the company's ability to meet its obligations. All that matters is your earning potential. Some argue that if a company goes bankrupt, bondholders have a priority over the assets, so they should be considered as well. However, Benjamin Graham contends that the primary goal of the bond buyer should be to avoid trouble rather than to protect himself in the event of trouble, as security is of the utmost importance when doing fixed value investing. It makes sense to assess earning power in difficult circumstances. So, today, you'd probably want to go back to the financial crisis to see how the company you're considering buying bonds from performed between 2008 and 2009. 3 coupon rates cannot compensate for a lack of safety. The investor cannot afford to take even a minor risk of losing his principal of $1,000 in exchange for an additional $50 in income from coupons. The entire premise of fixed value investing is that you shouldn't have to rely on future insecurities, because if you do, you must be able to gain as a reward for being right, because you will always be penalized for being wrong. And investing in bonds near par value doesn't give you that they don't appreciate in value unless interest rates experience a significant change, and no matter what, they will still be worth the par value at maturity. 4. Employ exclusionary and quantitative tests when investing for fixed value. One must do the opposite of finding bonds with the highest potential yields and then looking for safety. To begin, rule out any security concerns. When calculating interest coverage for interest expenses, start with a low standard and work your way up in terms of yields. You must include all obligations that are equivalent to bond interest, which may include expenses such as rentals and guarantees. Outside of interest coverage and market cap to debt, there are many other factors that could be considered to ensure the safety of a corporate bond. However, if you want to increase safety, you should increase your minimum requirements on these 2 points rather than complicating things by adding additional statistics. Less is sometimes more. As a side note, individual investors can obtain governmental-backed debt much more easily than individual corporate bonds. There are also other options for repairing value bonds, such as paying off your mortgage. The selection of fixed income investments, such as preferred stocks. Preferred stocks are similar to bonds in that they are purchased as fixed value investments. However, preferred stocks do not have a specific maturity date. However, companies may decide to repurchase the securities due to changes in interest rates. The main difference between bonds and preferred stocks is that preferred stocks do not have to be paid anything unless the common shareholders receive something. Benjamin Graham and David Dodd are thus very skeptical of investments in preferred stocks for fixed value purposes, and the fact that the typical preferred stock represents an unappealing form of investment contract is hardly open to question. On the one hand, both its principal value and its income return are restricted. The owner, on the other hand, has no fixed and enforceable claim to payment of either principal or income. The four guidelines previously mentioned for investing in bonds for fixed value purposes apply to preferred stocks as well, but due to the lack of enforceable claims, the minimum standards must be reduced to the following. Furthermore, the interest coverage ratio must include not only bond payments but also preferred stock payments. Only 5% of the listed preferred stocks met the criteria in 1932. Benjamin Graham concludes that not only are fixed value preferred stocks exceptional, but they must also be called novelties, or even mistakes, because they are preferred stocks that should have been issued as bonds whenever the company issuing the preferred stock benefits from its right to withhold dividend payments. The owner has no fixed value investment. On the other hand, whenever the issue is of high quality, dividend suspension is extremely unlikely. The issuer should have used bonds instead, which are typically more expensive. Takeaway number 3. Inadequate safety in senior securities. The market considers the previously mentioned Sanofi bonds, which have a yield of 1.23% until maturity in 2034, to be a safe investment. When compared to a bond from Bed Bath & Beyond that matures in 2034 but yields 7.68%, the difference is significant. Is this implying that there is a 6.45% free lunch? No way, no how. The bond of Bed Bath & Beyond is viewed by the market as having insufficient safety. As a result, the yield is higher. Such speculative bonds and preferred stocks should be viewed from the standpoint of common stock. Before making a purchase decision, the issuing company should be evaluated similarly. Furthermore, the fact that the coupon rate is higher than that of a high-grade senior security is insufficient. The security must also be priced at 70% or less of its par value. Why? Because, as previously stated, when you rely on future insecurities, as you will always be penalized for being wrong, there must be a reward for being right. In this case, the reward represents the possibility that the issue will appreciate nearly 50% in value to be priced at par. If the company does well, be aware that a speculative investment in a senior security should never be made. If it is necessary to assume that the common stock is also priced too low at the time, because if the investor is correct in his judgment of the common stock, it would be more profitable to buy the share rather than the speculative senior security, and if he is incorrect, the price of the senior security will most likely drop too. There is one exception to this rule, which we'll discuss in the fourth and final takeaway. Senior securities with the ability to speculate. Some senior securities have speculative privileges, which means they can no longer be classified as fixed income investments. There are primarily three types of such convertible securities. The owner of the security has the right to exchange his senior security for common stock under certain conditions, referred to as participation. The owner is entitled not only to interest payments, but also to additional income, which is usually proportional to the dividends paid on the common stock subscription. The holder of this type of senior security has the right to purchase common stocks on predetermined terms. The attractiveness of the securities form cannot be overstated. They provide maximum safety while also having the potential for unlimited value appreciation. However, when investing in this type of security, the investor must decide whether he is buying because of the attractiveness from a fixed value investment perspective or because of speculative participation in the common stock. According to Benjamin Graham, the terms of the agreement are more important than selecting the company with the most likely to increase in value. Not because it has a greater impact, but because it is more easily dealt with. Three perspectives should be used to evaluate the terms. The proportion of profit sharing allocated to investment. The higher the number, the better. Take, for example, Company A. Has bonds with a warrant attached, a subscription privilege stating that for every $10 in bonds, $20 in stocks can be purchased. Company B has bonds that allow you to buy $10 worth of common stock. If the value of the company's stocks rises, you want to be able to buy as much as possible, and thus the bond of Company A is preferable to Company B's bond. The proximity to a profit that can be realized. The closer you are, the better. For example, Company A has bonds worth $10 that can be converted into common stock. The current stock price of Company A is $9. B. Company has convertible bonds worth $10 as well. However, its stock is currently trading at $8. As a result, the bond of Company A is preferable because its stock only needs to rise about 11% before the convertible becomes profitable, whereas Company B's stock needs to rise 25% before the privilege of its bond becomes profitable. The duration of the privilege should be as long as possible. Assume Company A has convertible bonds for the next 20 years, whereas Company B has bonds that can be converted only for the next 5 years. Everything is the same. You'd rather have the bond of Company A, because you have the option to wait much longer for the privilege to become profitable in this situation. Switching occurs when the prices of a common stock and a convertible issue are exactly equivalent on an exchange basis. The two issues are said to be trading at the same price. When the price of the senior security is higher than the price of the common stock, it is said to sell at a premium. Finally, if the price is lower, it is referred to as a discount when a common stock is hyped up due to trendiness or something similar. There is significant speculative demand for the stock, which causes the convertible senior security to be priced near parity or even at a discount at times. Finally, we've discovered a situation in which a definite mathematical conclusion can be reached. In the field of security research. Here's an example from 1936 from Benjamin Graham's book. The Paramount Pictures Corporation had issued a preferred share with a $6 dividend that could be converted into 7 common shares at any time. At one point, the preferred stock was selling for $113 versus nearly $16 for the common. So the preferred share's speculative privilege was worth $112 at the time. Furthermore, the preferred share had a $12 accumulated dividend that had to be paid before the common stock received anything. If the common stock is worth $16, the preferred share should be no less than $124. In this case, the owner of a common share in Paramount Pictures Corporation should have switched into the preferred one. Such opportunities are certainly rare, and they're probably even rarer now than they were in Ingram's day. However, they may reappear in times of turmoil, and who will profit from them? Bonds of investment grade can only be found by insisting on minimum quantitative standards being met under depressed circumstances, and preferred shares are inferior to bonds as fixed value investments in their current form. However, such issues do exist. You accomplish this by raising your quantitative threshold. Senior securities of inadequate safety must meet the same requirements as common stocks, and they must be priced at least 30% lower than par. The attractiveness of senior securities with participation rights should be evaluated primarily from a terms perspective, and the investor wants to see high profit sharing to investment, a price close to a realizable profit, and a long duration in times of market turmoil. Mathematically demonstrated evidence occasionally presents itself, allowing the investor to confidently switch from one security to another.